Welcome to the fourth episode of Wealth Dialogues by DBS Treasures. Today we have a very interesting personality from the asset management industry, somebody who epitomizes a difference, something very for his simplicity, and he's somebody who, while being simple, also treads the of being off the beaten track with his ideas on investing, with his thoughts about how people should invest, how people go wrong in investing. And I have actually the pleasure of welcoming today Kalpen Parekh, who's the CEO of DSP AMC, who comes with a vast period of experience, vast knowledge that he carries on investing. He's seen life on all sides of the business. He's seen life on the consumer side of being the CEO, having seen different angles of investing journey. I now have the pleasure of picking his brains and understanding what his vision and what his perspective on investing is. Welcome to the podcast, Kalpen.
Thank you.
So before we get into the details of investing, I'd like to start off with your understanding of the markets. You have, as an asset management company, you guys are managing over 2 lakh crores of investor money, right? So what's the biggest impediment, in your opinion, to investors making money or the wealth creation that you have witnessed in India over the last close to 3 decades that you've been part of the industry?
Thanks for having me. And it's great to see DBS in action, in scale. Very credible name across Asia, one of the finest banks, and now offering its services to Indian wealthy families. We've been in this business for 30 years roughly as an asset management company. DSP has been around for 170 years as a group. So we've seen time, we've seen cycles, and we manage roughly 2.8 lakh crores, of which around 2.4 lakh crores is for Indian investors, and around 40,000 crores we manage for some of the largest pension funds and sovereign wealth funds of the world. So we manage money for Indian as well as global investors. So we've been exposed to different profile of investors, whether it is a retail investor all the way to the most advanced institutional global investors. I'll give you one statistic to give an answer to your question. Our oldest fund, one of our reasonably well managed consistent fund, it's called the DSP Flexi Cap Fund, has around 28 or 29 years of track record, 30 years of track record roughly. In this roughly 3 decades of history, it has earned around 19% CAGR. It has beaten its benchmark by around 400 basis points, which is a very credible outcome. It has grown by maybe 110 times or so. And in this entire history of its presence, 6 lakh investors have come in the fund and also gone out from the fund at different points in time. There are 23 investors who have earned the entire return of the fund.
Wow.
23. Out of 50 lakh investors who are invested with DSP today, out of 50 lakh investors who have come and gone. So we have 50 lakh investors who have come and gone away, and 50 lakhs who remain with us. So roughly over a period of time, 1 crore लोगों ने हमारे साथ experience किया है. They've been with us, they've been happy, sad, stayed, moved out. 23 investors have survived this journey of earning 19% CAGR.
And they've stayed consistently earning that 19% CAGR.
So they've earned 19%, but how many? 23. So markets give returns, funds give returns, but do investors earn them? And why is it that very few are able to earn the returns delivered by the fund or the market? Is because these returns don't come in a straight line of 19% every year. In these 29-year history of the fund, 30% of times the fund has given steep negative returns, where capital has, or the NAVs have fallen. Like the worst year was 2008 when it fell by some 50%. Then the best year was when it has gone up by 150%. So there are like 30% of times when it falls, around 25-30% of times when for 4 or 5 years it goes sideways, and then the balance 40% of time it rises very sharply. That is the characteristic of any equity fund. Whether you call it DSP FlexiCap Fund or DSP XYZ Fund or XYZ AMC's FlexiCap Fund, all funds have the same pattern.
True.
However, investors keep sometimes liking one fund because then that moment it does well, and then at some stage it goes through relative underperformance and somebody else does well. So there is huge temptation to get out. And then every time you get out, you pay tax. And when you get out, you're getting out at the low cycle of the fund and you're getting into another fund which is at its peak cycle. And then after being there for 2-3 years, you feel disappointed that, okay, this fund has not done well. So the challenge is that what we have seen as a barrier to wealth creation is this constant desire to act and constantly reacting to everyday new data points or new stories or new narratives or new themes coming in. And information overload was there 10 years back, 20 years back. Today on a daily basis, more and more information is coming. So it becomes very challenging for investors to eliminate the noise and stick to very few things that matter. And the most important thing that has mattered in compounding of wealth is time. I don't need to say this, all your wealthy clients who would be more wealthy than I am. It's ironical that someone who is less wealthy is advising people who have wealth. But people who have built wealth, it has come after decades of hard work, building a business and building value in that business. पहले हम 20-25 साल पढ़ाई करते हैं, फिर 25 साल बिजनेस बिल्ड करते हैं, तो रफली 50 साल लगता है वेल्थ क्रिएशन में. इन्वेस्टिंग में लोग 50 हफ्ते का भी टाइम नहीं देते हैं.
Interesting.
And that is, I think, the biggest opportunity.
So that's a psychological trait that you probably noticed, and that's the discussion I wanted to draw you into, because this is an area where you have sort of delved a lot and you have understood a lot of psychological traits. The last time we ever spoke on how people, what are the kind of pitfalls, the mistakes they make, the kind of psychological sort of problems that they go through in terms of the investing journey. Could you sort of get into some detail of what kind of typical behavioral traits that you see amongst investors? And this, I'm assuming, applies to all segments of investors.
See, actually, our behavioral traits or how we behave on a daily basis is a function of the human race we are. So we all are humans. Whether, it's very, sometimes I feel very naive when people write that retail investor hai to average hai and institutional investor hai to he is sophisticated. The only difference between a retail investor and an institutional investor is the institutional investor like you and me will be better dressed or having a tie suit and is working with Bloomberg terminals and more data. And the retail investor will not be. That's the only difference. And the retail guy has less money, we have more money. Okay. Apart from that, we are very similar in our behavior. Look at the most sophisticated institutional investors in the world. A lot of these global investors, the FIIs or the FPIs, right? 2 years back, like our investors, they were gung-ho on India. They were gung-ho on the manufacturing resurgence or the Make in India story or the Viksit Bharat 2047 story. They were all positive about it, including our investors. Suddenly today they are saying, no, India doesn't have AI because last 2 year returns here are not good and last 2 year returns are very high in many other markets. And rightly so, wahan pe returns are good, growth is there. So they are deserting a market which has given zero returns in the last 2 years to a market which has given 200% in the last 2 years. So like any other retail investor, people are chasing past returns. So the biggest behavioral expression that we bring as a human race is we like to extrapolate what is recent forever. So what's happening right now, we feel the future will also look very similar. So if the last 2 years have been mediocre in returns, we extrapolate that for the future. If the last 1 year is superlative for gold and silver funds, we extrapolate that for the future. If last 2 years are superlative for China and Korea and Taiwan, however, not many people even know that Korea has only 2 stocks, which are 60% of the market. So without knowing the risk, they are very excited today. Ki Korea mein kaun sa fund hai? So I'm not saying global investing nahi hona chahiye, but the reason why people love stories or love certain asset classes after they become popular, after most of the returns have come. So the biggest behavioral mistake we all make is become loyal to something which has started doing very well and give up our loyalty to what doesn't do very well, and not acknowledge that all asset classes are mean reverting, which means if something has done very well right now, in the next few years it will not do as well. And on the other hand, what has not done very well right now will start doing very well tomorrow. So this is classically like, let's say a cricket team is sitting for selection of the next match and the next 11 players. So one way to build the team is to say, okay, depending on the pitch condition and the opposition team, how many batsmen, how many bowlers, do I want fast bowlers or spinners, do I want more all-rounders? That's one way to think about the portfolio construction of that cricket team. The other way to think is, okay, in the last match these 3 guys didn't play well, in the prior match also they didn't play well, so let me dog them and get the guys who are playing well. In investing we do something very similar. We assume that form is permanent, whereas class is permanent. So in an asset class called equity, the class is permanent, that in the long run it does earn double-digit returns. But there are periods when the temporary form is
form
not
goes
good.
away.
So, but as investors we chase the form. We don't look at the class, and then we keep changing each asset class's perception basis the current form, and that's where most accidents
And does
happen.
this apply to the institutional investors as well?
It applies to anyone who's a human being.
Okay, so you've seen that kind of behavior also.
Universal.
Okay. Interesting. And so you have generally been an advocate, therefore, of doing investing in funds which already come in with the built-in mixture of multiple asset classes, whether it's multi-asset portfolio or some kind of an hybrid allocation that you think may be suitable. What's your
See, I think let me say this differently. If you are interviewing a pharma company CEO who is making, they are manufacturing, let's say 100 different medicines which are treatments for 20 different sicknesses. The starting point would be that for what sickness, what medicine is right. So for each individual, depending on what is the treatment to be done, the choice of medicine starts from that. Ironically, in investing, the question starts from a very generic thing कि आज कौन सा fund अच्छा है. The real point is that at any point in time, there can be 5 funds which are really good, but could be differently, packaged depending on the need of an investor.
Right.
So, my son is doing an SIP in DSP Value Fund, which is an equity fund which mixes India and global stocks together. My father's portfolio, he's a retired man who has no new income. He's largely in our asset allocation fund, dynamic and multi-asset, both are asset allocation.
Right.
My portfolio is actually incremented in the last 1 year. I've invested aggressively in our global equity fund under LRS, which does a lot of global stock selection. So in the same family, 3 generations, and all 3 have very different, incremental product selection, irrespective of the market being the same, because the objectives are different for each of them. So on the same day, or I'll give you one more example. My, someone asked me that I've just become a father and a daughter born in my family. What should I do? And this was exactly around 1 year back when small caps were falling. 1 year back there was some war. Abhi har saal ek naya war hota hai, so I keep forgetting, but something had happened last year in Jan, Feb, March, and some people, like some very iconic fund managers, had mentioned that small cap band kar dena chahiye, SIPs and all of that. So he said, should I do an SIP or not do an SIP? And I said, your daughter is just born few days back. You have a 30-year time horizon for her. You should do a good small cap fund instead of buying small cap stocks. But small caps have extreme volatility, including small cap funds, and hence do an SIP, because the expensiveness of the market today does not matter for a 30-year SIP, because only one installment is getting deployed. 30-year SIP means roughly 360 installments. So 1 out of 360 will go at expensive level. The second may go at maybe cheaper level, and it so happened markets were correcting. So all through the first 9 installments happened at lower and lower NAVs. and he could acquire more units for his newborn daughter. So again, on the same day, there can be different dimensions. What we say when we say multi-asset is for generally people. Again, most people like different asset classes at the wrong time. At the wrong time, people will chase Indian equities. At the wrong time, they'll get carried away to say कि अभी नहीं India नहीं करना चाहिए, global करना चाहिए. Like that's happening right now. At the wrong time, we will get excited about gold and silver. 4 years back, when we had launched silver, I think our NFO had 4 crores collection. Today, on a daily basis, there is demand worth 40 crores after a 300% of move. Wow. So the right time was then, not today. So now investors like each are the different asset classes: global stocks, Indian stocks, precious metals. A multi-asset fund ensures that all of them are there in your fund. It means the best performing asset class will also be there. It also means the worst performing asset class also will be there. But unlike our own misbehavior of ensuring that we put more money in the worst, in the current best asset class and most likely future ka worst asset class, left to ourselves, we chase the historically best performing asset class at the wrong time. And it means in future that asset class will underperform. A multi-asset fund will still own that worst performing asset class, but the weights will be lesser.
So you're cutting out the human judgment, which could be very erroneous.
You're minimizing the misbehavior that we demonstrate at extreme points. So just to give you a sense, when if you look at last 12 months of average purchase of a gold fund or a silver fund in our industry, around 1 year back it used to be 2,000-3,000 crores. This year in January, the fund industry collectively received 30,000 crores in gold and silver, from 3,000 to 30,000.
So 10x.
10x after the NAV moved out by 100%. A multi-asset fund, our multi-asset fund, had 22% in gold and silver 1 year back. Today it is 10%. So the fund is doing the opposite of what the consumer is doing. The fund had higher exposure to gold and silver when they were cheap.
Sure.
It has reduced it when they have run up.
So you're cutting out the recency bias out of this.
And we are rebalancing from that asset class to what has not done very well. Let's say bonds have not done very well, so it has allocated more to government bonds. Indian stocks have not done well. Banks in India have not done well, so it is increasing exposure to banks, for example. So it is buying what currently is not doing very well, because if cyclicality happens, mean reversion happens, these will be the winners of the next 3 years. So it is focusing on the losers of this cycle, because generally the losers of this cycle are the winners of the next cycle.
Taking that cue, if we were to sort of summarize and look at your broad investing philosophy, would I say that you would typically be a little contrarian to the market, contrarian to the recency, and therefore probably look at more consistency in this space? What's your thought around it?
Personally, my investing learnings have happened over 25-30 years by seeing these market cycles, and by learning that whenever I have invested in something which has done extremely well and hence is very hot and is very popular, has destroyed capital in the next 3 years. And if something is very hot, I'm waiting for a hot cup of tea, and if I just put my finger in that, it's very hot, I'm going to burn myself. The same way investing in a hot asset class is burning off your hard-earned wealth. And something which is very cold today, generally in the next round does very well. So history has shown globally that mean reversion works, and that is why some bit of contrarian investing is important. But along with contrarian investing, you have to also have the 2 other conditions. The first condition is the asset class inherently should be sound. And it should have some turning point triggers, because an asset class can remain out of fashion for reasonably long periods of time. And if it remains out of fashion for a very long period of time, so for example, 2010-11 to 2018-19, public sector companies in India were cheap and remained cheap and kept on becoming cheaper and cheaper. For 10 long years, you would have held on to all of them which were at half the P multiple of the rest of the market. They were cheap, but the confidence on their ability to improve their ROEs came only after 2019, when the government also put a lot of focus on them, saying that you have to become more capital efficient, you have to reward the shareholders with better ROEs. And there were a lot of other macro environmental triggers which ensured that, like, a lot of PSU banks were cheap for a very long period of time because the private sector banks were doing exceedingly well and their stocks were cheap and they were fairly priced. But it so happened in 2019-20 that 2-3 of the largest private sector banks went into either a management change, or their valuations had become very expensive, or there was a massive transition of their business model. And by that time, the PSU banks not only were cheap, but their balance sheets had been cleaned up. The private sector banks were taking their own time to put their act together, and these guys started lending aggressively. And they got a massive growth cycle, which led to a huge PE re-rating. So less than 1 time price to book versus 4 times price to book of the private peers. Right. So that turning point had a couple of triggers of the private sector banks giving up market share in some segments. So without that trigger, this would have not happened.
But to take advantage of that, you would have had the patience to stay put with these private public sector banks for a long
period. More than that, see, it was okay for most people to be impatient. Because for 10 years, if they have not seen inflection in their profit growth, the valuations are cheap, but the profit growth inflection was not happening. But certain turning points happened around the period of COVID. Then Ukraine-Russia war happened, and everywhere government said that we need to invest in defense. We need to create our own self-reliance on everything related to defense. And Indian defense stocks, which were at reasonable ROEs, very cheap valuations, suddenly got derated because the government said we'll give you more contracts, more mandate, which led to an earnings growth revival. The trigger came towards the late part of the decade. So even if you were patient all through, it wouldn't have helped, because for not earning any return for 8-9 years is huge loss of IRR. If you would keep money in a government bond, you would have earned 7-8% annually. So, just buying cheap because it is contrarian alone is not useful. You need certain other dimensions, other nuances, other layers to build a portfolio where triggers are there and inherently the asset class is attractive. Let me give you another example. There are many stocks which fall 30-40%. The average investor thinks it's cheap because it had gone to 100, up 60 pe mil raha hai. So versus 100, 60 is cheap. It is called anchoring bias. You are anchoring to 100 rupees as a price. What if the intrinsic value of that company is not more than 40? Even at 60, it is expensive. At 100, it was stupid to buy.
Correct.
At 60, it is less stupid to buy, but it is still stupid because the fair value of that company is 40. और पैसा अगर बनाना है तो fair value से नीचे में खरीदना पड़ता है. So it can still fall by another 30%. There's an example, one of my colleagues keeps quoting that, generally we always have learned that consumer companies or multinational companies are safe. Consumer companies are defensive, right? You would have heard many times, FMCG is defensive. In Unilever stock, I think in Indonesia fell 50%.
Wow.
So you can say that now it's cheap, 50% down. Contrarian investing says that if something is down 50, paisa ban jayega. After that, it fell another 50%.
Oh my God.
Because either starting valuation बहुत महंगा था, valuation कम हो गया, उसके बाद growth चला गया. So it's not simple, just one line hypothesis. So even sometimes, when I hear my podcast, I get bored also, because when I try to give too many nuances and layers, it drifts. But the truth is, one line statements also are misleading and dangerous.
Yeah. No, so so that's a nice way to summarize the kind of biases that we have. But we've seen the last decade showing all kinds of negativity, which sort of led to a market which was decade from 2011 to maybe towards 17-18. You saw a lot of these events which were still keeping market on hold, and now you've had a situation where, despite post the COVID in particular, markets have been on one-way run, and it's had to take a large macro event globally which put some brakes to it. But if we go by the general narrative around, there seems to be still a lot of bullishness. What's your view on the macro story of India in the short term, in the long term? What's your general view here, and how do you see investing in the current phase?
See, one observation I would make is that at any point in time, there is a bull market in some part of the market, and there is a bear market also in some part of the market.
Right.
And likewise in the world, with all these uncertainties. US is at all-time high. I was surprised to see Israel and Iran are at war. Israel market is at all-time high.
Wow, yeah.
So there are times, what we think versus what happens in markets in the short term is too random. So in fact, anyone asks me for a short-term view, all I say is that अगर आपके जेब में wallet है तो एक coin निकाल के toss कर लेते हैं. My view is as good as a toss. Anything can happen in the short term. Anything means it can go up 50%, it can fall 50%, it can go sideways. There is no framework to judge that एक साल में क्या होगा. It's very difficult to judge. The only time I'm very confident about the short term is when markets are at extreme valuations. Then I know that from here, very likely in the near term, next 1 or 2 years, it will disappoint. Or anytime it's very cheap, like 10, 11, 12 P पे पूरा market available है. For a market where the inherent intrinsic value should be 16, 17 times, then at such valuations you say that from here you will not lose money, most likely you will make money in the next year or two.
And sooner or later it should come back. At
extreme points, it is more clearer. But when you are in the middle, it is flux. And when you are in the middle, it can go anywhere. It can get re-rated to a higher valuation and make returns. It can get derated to a lower valuation and not make returns. So currently, India is somewhere in the middle. In 2010, 11, 12 and 13, in those 3 years, the beginning of the last decade, our macro was very weak. Our currency had tanked. Our twin deficits were getting worse. The fiscal deficit and current account deficit both were high, and the total was very high. Inflation was very high. Because of attack on currency, interest rates were hiked overnight by 300 basis points by Reserve Bank. So 2013, everything was negative. We were a part of Fragile 5.
Correct.
At that time, all headlines would tell you don't invest. And the best returns were made in the next 5 years or in the next 10 years. So if you today also just see 2013 to 2023 returns, they were 20% CAGR. From an asset class which normally does 12% CAGR. So we almost earn 2 times of what the asset class earns when you invest in a bear market. We love to invest in a bull market. Bull markets have poor returns. Bear markets give you above average returns. So point I'm making is right now we are in the middle. Our growth rates are middling. They are not growing very high. They are not too bad. Our valuations are not the highest, but they are also not very cheap. So our average range of valuation has been 12, 13 times in bear markets to 25 times in bull markets. Today we are at 18 times. So can 18 go to 16, 15? Who knows? Can 18 go back to 21, 22? I don't know. And when you don't know, you diversify. So the entire objective of multi-asset allocation or diversification is that even if your view goes wrong, you don't get thrown out of the game. Your compounding journey will continue. You may not earn 15%, but at least you will earn 10% and keep compounding. That's the whole objective of diversification. So answering your question, we are in a middle of the path market right now. Nothing exciting, but nothing that bad also. And large parts of our market are right now at a 5-year low. Banks for 5 years have gone nowhere. Shareholders, equity holders of bank stocks have earned lesser return than an FD holder of a bank. It is unusual. A bank generally has 14-15% return on equity. The shareholders should broadly earn that. Instead, they have earned 4-5% absolute, not even annualized. So that is a segment which is getting cheap. Tech stocks have corrected very sharply. They are at 4% free cash flow yield. Now, of course, there are doubts about their business models because of AI, etc. And some of them are very valid. Some of them you don't have answers overnight, how will this evolve? But 5% free cash flow yield is not available all the time. You get it only when there are these type of doubts. So there are pockets of opportunities. There are pockets of froth and bubble. You have to discern and find the right segments to invest in.
So one pocket of, taking a segue from your last point, one pocket of, froth that we believe, or could be a froth, could be a game changer, could be this AI boom that's really taking, the market by storm. I mean, it's taken away a lot of the foreign institutional investor money out of India. And that could be the cause for worry for, let's say, the larger asset managers or market watchers, what's your view? How do you look at this phenomena? Do you think it's a short-term frothy situation, or do you think it's going to change the way the world operates and meaningfully alter a lot of things that look, settled right now?
See, AI impact is real. So two things to be mindful of. In the last decade, the biggest winners in the world in terms of the stock market were these tech companies, the global tech companies like an Amazon or a Google, Alphabet, Apple, Facebook, Meta now. And these guys were generating huge free cash flows, which was retained with them. And they were using it to also do buybacks. So when they do buybacks, they are reducing the number of shares.
Correct.
So even if profits are growing slow, the profit per share becomes better. EPS becomes better. And they had very high return on capital. The ROCs were 40-50%.
Right.
Now, since the time this AI fight has started, everybody is massively investing in research, spending on AI. So, on an average, if these 5 companies, 7 companies would spend $100 billion annually on R&D, now they are spending $700 billion a year.
Okay.
So, in return on incremental investments or return on incremental capital will be far sharply lower than their lifetime ROEs. And which is where some point in time, and no one knows who's going to be the winner.
Right.
We'll have to wait and watch. So it's not easy. But now you have to ask this question: ये 700 billion जा कहाँ रहा है? If they are investing so much in capex or R&D, who is receiving this money? And the guys who are receiving this money are the semiconductor companies or the data centers or the whole chain which is supporting these data centers. So it's basically profit pool shifting from one part to the other part. And semiconductors, again, while very fashionable today, very profitable today, is a deeply cyclical industry. So globally, many of these semiconductor companies for 10-15 years have given zero returns. And then the next cycle starts. The next cycle of tech innovation happened, demand for semiconductors goes up, and all these stocks are doing very well. So we have a company called SK Hynix in one of our global funds, in our multi-asset as well as value fund. We bought it, I think, 2 years back at single-digit PE. It has gone up, I think, 7 times. After going up 7 times, it is still at single-digit.
Single-digit PE, yeah.
It means the profit growth is humongous right now. And they say that for the next 18 months, all their chip orders, जितना भी वो chip manufacture करेंगे, वो पूरा sold out है.
Wow.
Because there is enough demand. Now, when there is this type of demand craze, all companies will expand capacity. And there will come a point, whether 3 months from now or 3 years from now, I don't know, where so much new capacity will come in and demand will start slowing down, that the supply will become larger than demand and the cycle will change. Now, these are the super cycles. There are times you have super cycle in oil. There are times you have super cycle in metals. There are times you have super cycle in semiconductors.
Technology.
So that is the super cycle going on right now. And then with so much of announcements happening every few days on the AI side, it is putting a question mark on business models of traditional software companies or data companies, or like if you see globally companies like FactSet or companies which used to do data analysis and interpretation.
True.
They are all getting disrupted. Their stocks are down 40-50%. So on traditional metrics, they start looking cheap. But today the worry is that will their business models be very different tomorrow? Will they even exist, or something new will take them over? So these are the worries. So I think we are in a state of transition, state of flux. So we in our portfolio typically have a balanced approach. We have enough companies from the old FANG universe where we see that they are not very expensive and where there is no risk of disruption to their own business. They are respecting their cash flows and doing very well. We find similar companies in other parts of the world where because of their country dynamics, the stocks are cheap. And then we are also investing in select semiconductor companies which are beneficiaries. Then you're also seeing because of tariff and generally slower growth in the world, many consumer stocks have fallen by 40-50% globally over the last 3-5 years. they are now coming closer to single digit valuations or 11, 12 times PE multiples. So there are pockets of opportunities where there are huge bear markets going on. Where for the last 5-6 years, these companies are down 40-50%. So 5 years of time loss and also capital loss. So this is the time to build a diversified portfolio and not take any one camp.